Hello, dear colleagues. Can you hear me? All's good? Can you see my presentation? Yes, all's good. Let's start. Just a second. Today we have the lecture number 7, and the main topic of our lecture will be real option valuation. First of all, a few words about our future course, about our future perspectives on companies' valuation and investment analysis. We have changed the schedule of this course. We'll meet during 2 lectures in 2 weeks, and each week we'll have seminars. In this model, we'll move to companies valuation, and certainly we started our companies valuation in previous school year in our asset valuation, but in this model we'll refresh in our memory the main concepts of companies valuation, and we'll make knowledge on different special models in companies valuation. We'll concentrate on our terminal value, and we'll start not real practice in companies valuation as we started real practice, and we made knowledge on the model of companies valuation in our previous course. In this course, we'll find the solution for different theoretical questions, for different theoretical tasks on companies valuation. We concentrated on a real scenario in companies valuation, and we studied 3 main approaches in our previous course, and in this course we'll refresh the main characteristics, as I said earlier, of companies valuation, and we'll concentrate on different cases in companies valuation and special cases and special topics in our companies valuation. And in this model, we'll move to companies valuation from our investment analysis to companies valuation. And today we have a first topic. To tell the truth, this topic is the connection between our investment analysis and companies valuation, our real option valuation. But first of all, a few words about our homework and about our quiz. In this model, we have to pass the quiz. If I'm planning, we'll spend our quiz in the first part of the second model. Certainly, I'll announce you the date, the day of our quiz, but I think our quiz will take part after 3 or 4 seminars on our investment analysis and companies valuation. But certainly I'll announce before the quiz the correct, the defined date of our quiz. And by the end of our second model, we have to present our homework. And as we analyzed the structure of our homework earlier, first of all, you have to prepare this homework in groups. As about the structure of our group includes not more than 4 participants, as we decided earlier, and 3 main steps of your homework. First of all, you have to choose a company. It depends on your choice, a foreign company or Russian company, but the main purpose is the deep analysis of investment pursued in this company, deep analysis of investment project in this company. First of all, certainly you have to detail the company. You have to propose the definition of the main purposes of this company, of the main goals of this company, of the strategy of this company. Or you have to propose the description of financial structure of this company. Secondly, you'll prepare the definition of investment policy of our company or description of the company's investment activity, such as investment potential, main projects which have place in our company, main areas of investments, perhaps well-known projects in your chosen company, perhaps the main achieved results in investment policy of your company. Then you have to present the information about the main resources for financing the investment activities of the company. Perhaps our company chooses self-financing, perhaps our company prefers financing by using the attracted capital, by initial purpose offering, for example, or by issuing the bonds, or perhaps our company uses the simple instrument of our debt, such as credit or such as loan or such as bonds, for example. And then you'll present key results of ongoing projects and outline or determine the specifics of company's investment activities. And as I said earlier, well-known projects of our company and the results of these projects. And the third part includes the description of the selected investment project. In other words, you have to accumulate, you have to gather all information about cash inflows, cash outflows of the chosen company, and certainly to propose the purpose of this project, the timing of this project, in other words, the time horizon of this project, the start and the planning period of finishing this project, and the main sources of funding. Then you have to create a calculation model and present the information about incomes and expenses for your chosen company. Then you have to approve the discount rate for your chosen project, perhaps as we detailed or as we detailed this point in our previous lectures. Perhaps you'll choose, for example, CAPM model, or perhaps you'll use the cumulative approach in finding the discount rate. Perhaps you'll take the cost of your debt. It depends certainly on the main resources of financing our investment project. And then you have to calculate the project efficiency, such as key parameters, which we studied earlier, such as static and dynamic parameters for investment project. I don't know, such as, for example, discount payback period, simple payback period, certainly net present value, certainly our internal rate of return, perhaps average rate of return, perhaps our modified internal rate of return, and certainly our payback period based on our discounting pursuit or without including the discounting pursuit method. And then you have to identify the main project risks and develop a risk management for the company. As the final result, as the form of presenting your research, you'll send in LMS, in special portfolio projects, you'll send two obligatory documents such as presentation describing the company's investment policy and the main results of your project, and your calculation file. The calculation file includes the description of expenditures, of incomes, of discount rate, of finding main parameters of our investment project, and the demonstration of the pursuit of project valuation, certainly. And as the part of your calculation file, it will be the presentation of the main risks of your project and the modifying the influence of this risk on the elements of our project. Perhaps is it necessary you can also provide a description of your entire job with a project report in a separate document. As about the deadline for your homework is the second part of December, and by the end of 12th of December, you have to put your documents in special place and special portfolio projects. And it will be the mark on your homework. And I think in the beginning, perhaps in the beginning of December, we'll have the quiz on our investment analysis. And now, if you have no questions, let's say I'll check the chat. Good morning. Can you repeat, please, how many people should be in one group? Not more than 4. Yes. There are only quiz and homework in this model. There are 2 forms of control. First of all, the quiz, and secondly, homework. And certainly your participation in lectures and seminars, and certainly I'll put mark on your class assessment. And to another forms such as homework and such as quiz. In other words, by the end of the second model, I'll determine 3 marks on your class participation, on your quiz, and on your homework. Good. Now let's start our presentation. Let's start our real option valuation. And if you have any questions, you can write in chat, certainly, or you can use the microphone. Now let's start using option pricing method to value flexibility. Real option valuation is very interesting. It's not an ordinary tool. It's not an ordinary instrument. As for our investment analysis, so for our company's valuation. Sometimes we can name our real option valuation as the tool for definition the risk influence on results of investment project. Certainly, when we calculate the results of our investment project, we have to, first of all, to forecast a more realistic scenario. And in this real scenario, we have to calculate our net present value, our internal rate of return, and different other parameters. But sometimes we have to add the influence of risks in our investment project, and under the influence of risk in our investment project, we have to forecast the behavior of our investment project and the main results of our investment project. And when 2 characteristics will be the same as the influence of uncertainty and the possibilities of our company to be flexible, and the possibilities of our company to react on the conditions of uncertainty, in this scenario we can add and surplus opportunities in our company. In other words, the opportunities of our company not only to react on external conditions, but to reform the strategy, to reform the parameters of investment project based on external conditions. And in this case, first of all, we have to find laws and hidden opportunities in our company, such as real options. There are different definitions of our real option, but I'd like to propose you a classical synonym for our real option, such as flexibility. Flexibility and opportunity to react and to reform the strategy according to the external and sometimes internal conditions. For example, if we are proposing the classical examples of our real option, our company can finish, for example, the investment project and sell all equipment and sell all strategies to another participants. And for example, in situation of negative financial results of our investment project, our company has the opportunity to finish this investment project, to sell all equipment, and to receive added cash flows to start a new project, for example. Or if external conditions are good for continuing the project and to increase the capacity of our project, our company has the opportunity to boost the scale of our project and to boost the opportunities, the results of our project, and for example, to increase the production forces according to the external conditions. Or perhaps our company has different equipment, has different technologies, and can switch to another activities according to the market purposes and according to the market expectations. And all these examples are the examples of real options. For example, as the instrument of financing the activities, our company uses the lease contracts, and according to the classical lease contracts, according to the classical financial lease contract, our company has the opportunity to buy the equipment on rested on a terminal book value in the end of this lease contract. And certainly it's an example of our real option, when our company has the opportunity to sell or to buy the equipment, to sell or to buy the technologies in the end of investment project. Or our company has the opportunity to react to different conditions. And in this case, first of all, we can find similar characteristics between financial options and real options. I'm sure you studied financial options in previous courses, for example, in courses of Yuri Rolandovich. And in my lecture, I'll try to find the similar characteristics between financial options and real options. To tell the truth, if we are summarizing the history of appearance of our real options, first of all, certainly financial options appeared, and financial options on stocks, on shares, financial options on currency, financial options on different financial indexes appeared. And Secondly, our company used different kinds of financial options, started using real opportunities. Comparing with financial options, our real options quite difficult to be founded in, for example, in assets of our company or in P&L of our company. If we are analyzing profit and losses report of our company, certainly all results of using our financial options are presented in the part of, for example, our incomes or our losses, such as profit and losses after hedging of derivatives in our P&L report. And as about our real options are quite difficult to be defined, to be founded in our P&L of the company or the financial balance sheet of the company. But on the other hand, our company takes in mind the flexibility in a situation when, for example, the results of our investment project are negative. Or, for example, in case when our company receives a negative valuation from investors. And in this case, our company will present the opportunities, the flexibilities, and certainly these opportunities and these flexibilities can increase the financial results of our company. To tell the truth, our option pricing method is an added method for our discounted cash flow approach, which was started in our asset valuation, and it's an additional element because this method explicitly captures the value of flexibility. Sometimes after receiving a low negative results based on our discounted cash flow approach, we can find the opportunities of our company, different possible actions of our company, and adding these opportunities can maximize the results on our DCF approach. If we are following a classical definition of our real option valuation, according to this description, an option gives its owner the right, but not the obligation, to buy or to sell an asset and a predetermined price, called the strike or exercise price, for a predetermined period of time. In other words, for buyer of our option, it does not matter for financial option or real option, it's the opportunity, it's the right to realize in actions such as buy or such as sell an asset based on predetermined conditions. In other words, the price, the amount, the period of expiration of this option will be determined earlier, and our option buyer receives in this situation only the right to realize this option. But certainly our option owner can project or can refuse the opportunity of using our financial or real option. It's only the right, but not the obligation. And the right to take an action is flexibility, and sometimes certainly we can divide this opportunity, we can divide this flexibility according to our actions. As you know, in our financial options, we can buy an asset, and in other words, it will be call option, or we have the opportunity to sell an asset or to realize this asset, and this kind of our option is named as put option. And in this situation, we can divide our options into two groups, such as call option and put option, according our action based on our operation. But certainly we can divide our option into two groups according the period of realizing this opportunity, such as if we have to realize this opportunity in determined period of time, this option is named as European style of option pricing and of option valuation. And if we have the opportunity to realize our option during the determined period of time, but not later than the predetermined day, during the period, this style is named as American style of option. The determined day and only in determined day, this option is named as European style, and during the determined period, but not later than the predetermined day, this option is named as American style of option. And certainly, if we analyze our real option valuation and if we analyze our opportunities of the company, we can find our options on the side of assets or on the side of our obligations. For example, if our company issues warrants and has the right to buy the stocks or the shares of our company in determined period of time, our warrants can be named as an example of option when our shareholder or stakeholder receives the opportunity to buy the shares of our company on determined conditions, on determined price, on determined period of time, in determined amount. If our company, for example, issued the convertible bonds, certainly our convertible bonds can be named as the classical example of our option. In other words, receiving our convertible bonds, you are receiving the opportunity to check or to transform your convertible bonds into the shares under the predetermined conditions. And as about the examples of real options in companies valuation, I presented the classical examples on this slide. For example, to delay or defer making the investment, and it will be the option to delay, adjust or alter production schedules at price changes, flexibility. We can increase or decrease our production capacity in our company. For example, our company has an opportunity to expand into new markets or products at later stages in the process based upon observing favorable outcomes at the earlier stages, expansions. And as an example of expansion, I'd like to present the following example. It's an example of our insurance market. Many years ago, in 2011 and 2012, insurance company of France, our AXA, well known, diversified insurance company of France, AXA, had an opportunity to buy 25% of Russian insurance company Resgarantia And 25% of shares could be bought by AXA on predetermined conditions, but not later than 2012. And the life of this option, the period of existence of this option it's about 4 years, and during 4 years, in every moment during these 4 years, AXA company had the opportunity to buy 25% in Resa Garantia, and certainly was as a control portfolio in Resa Garantia. But according to the conditions, according to the external, first of all, external conditions, and based on market risks, AXA rejected of using this option, but certainly this opportunity existed in this previously proposed period of time. As another example of our real options, our company has the opportunity to stop production and abandon or leave investments if the outcomes are favorable at early stages. And as a kind of our option, it will be the option to abandon the project. Put another way, real option advocates believe that you should be paying a premium on discounting cash flow value estimates. And certainly in our project, our real options have another reflection, and they can modify, they can change the financial results of our investment project, first of all. Later, we'll analyze the conditions in which it's more appropriate, it's more correct to use our real options. But finishing our classification, later I'll return for more developed classification of our real option. Continuing the classification, I'd like to propose the following version of our options, such as contractual options, for example, all concessions, mining concessions, and franchises. Certainly, in my practice, I met a lot of real options in the structure of our oil and gas companies. All license, all opportunities to start the investment project in every year, but not later than the defined period of time. All these options can be named as a classical real option of the company. If our company has a license, if our company has research and development results, as our company possesses the patents, all these cases can be named as real option. Certainly, they are not so strong as our financial option. They are not so determined with defined characteristics as our financial options, but all these opportunities can influence the financial results of our company. As the option of growth, learning options, for example, the option to expand, option research and developing, acquisition, our classical option acquisition, and the beginning of 2000s, foreign company Unilever had the opportunity to buy a Russian company, Black Pearl, Черный жемчуг in Russian, and in other words, Unilever had the opportunity to totally buy 100% of shares of Russian company. And certainly the deal of mergers and acquisition took part in the beginning of 2000s, and Russian company Black Pearl was acquired by foreign company Unilever. And it was an example of the real option to expand, to receive a real place, to receive real financial results in Russian financial market after acquisition with our Russian company. New business, new customers, internet venture can be presented as our real option valuation companies. And certainly options to flexibility, such as defer the investment or downsize the project, or different alternative uses of different assets of our company, outsourcing to abandon the project, to abandon the capacity of this project, and certainly the modification of our products can be named as real option valuation. And if we analyze an example, the activities of Amazon company, an Amazon company, we can find the following examples of our real options, such as, for example, new business options, the shops, a marketplace, Amazon Actions, an action market, and it's new business, drugstore.com, beauty and health product, Ashford.com, Della.com, Pets.com, the goods for pets, Greenlight.com, different goods for automobiles, and so on. In a period between 1998 and 1999, Amazon made 28 acquisitions, and all these acquisitions can be named, can be realized, and examples of real option valuation. Expansion options says Amazon entered the European market in 1999. It's the opportunity to expand, the opportunity to start a new production cycle in a new market. Growth option through customers, Amazon started to sell music videos, DVDs in 1998. And software, toys, electronic products in 1999. And perhaps as an example of certainly our real options, efficiency improvement option to increase the entire barriers in 1999, Amazon invested more than $300 million to improve its technological infrastructure and in patent the pursuit called one-click for greeting service, verification of email order. And when you start preparing your homework, if, for example, you analyze, I don't know, well-known projects of Gazprom company or Norilsk Nickel, for example, or Lukoil company, certainly in definition and description of investment projects of these companies, you can find a great part of real options, certainly. And if you want, you can add a real option valuation in evaluation of your investment project as an advice for your homework. Or perhaps you can, for example, remove your classical investment project calculation, your classical investment project approach by the valuation using our real options. It depends on you, your choice. Good. And a few words about the theoretical side of our real option. An option provides the holder with the right to buy or to sell a specified quantity of the underlying asset at a fixed price before the expiration date of the option or in the expiration date of this option. And we proposed earlier the classification before the expiration day. This style is named as American style, and in expiration day, this style is named as European style of option. And there has to be a clearly defined underlying asset as value changes over time in unpredictable ways. And certainly our real options help us to fix all conditions in a spot moment of time. Certainly our company receives the opportunity of using of expiration real option under the pressure of different risks, under the pressure of internal and non-diversified risk for our business. And on this slide, you can find the diagram on a call option. And as we said earlier, our call option gives us the opportunity to buy an asset at the predetermined conditions. And certainly for us, it's necessary to realize this option in the following conditions. When the market price of this asset will be higher comparing with our strike price. And in this slide, on this picture, you can find the strike price, our predetermined price. And certainly don't forget about the premium, which we have to pay for our option. And certainly this premium is quite changeable according to the conditions. As about our financial options, we have to pay the premium, the determined amount of our premium, and it will be the premium for our financial option, for example, as the part of your profit or the fixed amount. And as about our real options, the premium for our real option can be presented in the following way. It means our possible losses as we are changing the period of the project. For example, our delay or our losses if we have no opportunities to start our project in a current moment of time, and we have to change the period of starting our project. For example, our losses in share yield, in dividend yield of the project of the company. As an example of our premium in real option, I can propose you the following. If our company has to make any prepayments or payments in advance to guarantee, first of all, to guarantee the opportunity to sell an asset in predetermined conditions. Or, for example, our company has to pay a higher rate on lease agreement, on lease contract, to receive the opportunity of buying an asset in determined conditions after the period of practical using of the lease objective. In this situation, analyzing this slide, we'll receive a real opportunity to realize and to receive profit on our real option if the market price will be higher comparing with our strike price, or it will be the right part of our graph, price of underlying asset. And as an example, product patterns as an option, and in this slide, if we are transforming if we are moving from classical diagram on call option to our product patterns as an option, our initial investment in the project can be named as a kind of our strike price in this case, and we are transforming from negative net present value in this section to positive net present value in the second section, and present value of expected cash flows of the project on the line of X, and the project's net present value turns positive in this section, as you can notice. And for example, different payments for our patterns, the value of our pattern can be named as a real option premium in this case. Another example of a real option in our investment project valuation, undeveloped oil reserve as an option, and cost of developing reserve can be named as our spot price, our current price, and our net payoff of extraction, if net payoff of extraction, payments for our extraction, will be higher comparing with our price of this option with our expenditures. Certainly it will be the choice for us to realize this option or to reject this option. But certainly if cost of developing reserve will be low comparing with our expected profits, we'll realize this option. But as an example of option, we have the opportunity to expect the best start of our option, the most profitable point of realizing our option. And now let's start different tasks based on our options. And as the first task, as a first example of calculation our real option, I'd like to propose a classical example of our real option. And to tell the truth, I can name this task as the start point of our real option, or as the born of our real option, and our possibilities under the uncertainty, our opportunities under the uncertainty, our choice between expectations or starting the project in a spot moment of time. And first of all, our definition of real option appeared in the book of Dixit Pindyk, Investment Under Uncertainty. And they propose the following example of our possible actions under the uncertainty. And I think this example helps us to understand different benefits, different profits under the uncertainty. Let's suppose we have to invest 1,600 in a new project that makes widgets. It does not mean it means first of all to produce anything, our widgets, anything. We don't know what. The cash flow per good, per unit, is $200. In other words, if we invest 1,600 in a current moment of time, we can expect $200 by the end of the first year. But our profits will change to either $300 or $100 at the end of the year with equal probability. Let's analyze, let's explain the conditions. If we start the project now and if we invest 1,600 now, we'll earn $200. But if we expect 1 year and if we invest 1,600 in the end of the first year, under the changes in our market conditions, our profit will be $300 or $100 at the end of the first year with equal probability. After that, it will stay at its new level forever. Note the expected future cash flow is $200 in all cases. If we invest now, it will be $200, and if we invest by the end of the first year, the average meaning or the middle meaning of our investments will be the same, $200. But we have the opportunity to increase our profits to $300 or to decrease our profits to $100 with the equal probability. The cost of capital, let's suppose, is 10%, and assuming that one widget can be sold immediately and one per year thereafter. Now, let's calculate net present value of the first scenario of the investment, of the starting investment activities now, or the second variant, net present value of starting our investment activities into 1 year. And let's compare our results. In this case, I'll use the formula of perpetuity annuity, and in this case we have the opportunity, first of all, to use our stable growth model, and according to the mix of our perpetuity annuity and our stable growth model, we have two formulas. The first variant, if we start our investment activities in a spot moment of time, we can start our investment project or we can reject our investment project. And certainly, if we reject our investment project, our net present value will be zero. We won't invest and we won't receive benefits. We won't receive profits. So while we have to choose between starting investment project and rejection the investment project. Net present value in our first scenario, it will be maximum between two meanings. Our investments, we have to invest now 1,600, so y with minus, plus the sum of all our expected benefits in $200, and our discount rate 10%. In this case, we can use the following formula. First of all, as we invest now, but our benefits will be received by the end of the first year. So why I'm using the following formula, it will be our expected results, $200 multiplied 1 plus 1. In other words, 10% I took as the growth in this situation and divided by cost of capital. As we used in finding our terminal value in our asset valuation costs, and as we summarized this formula in our spot costs. It will be 1,600 plus 2,200. In other words, it will be 200 multiply 1 plus 1 or plus 10% and divided by 10%. Our perpetuity annuity meaning or formula. And the expected result of this investment project, if we make the decision of investments in a spot moment of time, net present value will be $600. If we are ready to expect 1 year, our benefits will vary from 100 to $300 and with the same probability. In other words, it will be 50% probability maximum between minus 1,600 divided 1 plus 1 or 1 plus 10%, as we will invest into 1 year. It will be minus 1,600 divided 1 plus 10% plus the sum of all our expected results, such as 300 divided 1 plus 10% to the extent t starting from 1 to infinity, or 0 if we reject the project. It's the first solution. The second solution with the same probability of 50%, it will be maximum between minus 1,600 divided 1 plus 10% plus the sum 100 divided 1 plus 10% to the extent infinity, but starting on the first period and finishing in unknown period and 0. It will be 50% multiplying maximum between minus 1,600 plus the same, our growth will be added to $300, 3,300 divided 1 plus 10% or 0. And in this situation, it will be minus 1,600 plus 1,100 and divided by 1.1. Secondly, if under the uncertainty, if by the end of the first year we make the solution of rejection the investment project, or perhaps if under 1 year the external conditions will become similar and will become predictable for us. And if we analyze our expected financial results, will be 100, certainly will reject the project. If we are expecting 1 year and analyzing the external conditions will make the solution that our external conditions lead to receiving $300, certainly in this situation we'll accept the investment project. And so why? Using these conditions, you can make the solution, you can make the decision that it's necessary to expect 1 year and then to make the solution about investments and or rejection the investment project. Net present value or option value of this investment project will become 733. And the higher the difference between our expected results, the higher the meaning of our net present value of this investment project will be. And it means the pressure of our uncertainty, and under the pressure of our uncertainty, we can increase our opportunities, first of all. And following the conclusion of this task, I'd like to add the following scheme of using our real option You can find the graph, you can find the following table, our ability to respond and our uncertainty. And certainly, you can determine the increasing of ability to respond and increasing of our uncertainty. If we have a ability to respond, if we have low opportunity to flexibility and low level of our risk, certainly it will be low flexibility value. With increasing of our uncertainty, but with a stable low level of our ability to respond, to react for our conditions, or with the increasing of our ability to answer for uncertainty, but a lower level of uncertainty, we'll need moderate flexibility value. It means for us, it's not necessary to find our real option flexibility, our real options in our actions, and we have to realize our investment project. But in conditions of a high level of uncertainty, in conditions of a high level of response to these conditions, high level of flexibility will receive high flexibility value. In other words, flexibility value greatest when high uncertainty about the future, very likely to receive new information over time. Let's return for our task. If we are ready for expectations of 1 year, by the end of this first year, we'll receive the understanding of our real profits, and perhaps these real profits will be higher comparing with the spot variant, with the spot result. High room for managerial flexibility certainly allows management to respond appropriately to this new information. And in the situation when our net present value is not negative or is not positive, our net present value equals 0. Certainly in this situation, as a good advice for us is finding the opportunities of our company, the flexibility of our company, and certainly to react for this flexibility. Net present value without flexibility near 0. If a project is neither always good nor obviously bad, flexibility to change course is more likely to be used and therefore is more valuable. And under these conditions, the difference between options valuation and other decision tools is substantial or is determined or is highlighted, as you can notice. And now let's find the main parameters, and later we'll start the model of valuation our real option. Certainly we'll start on our Black-Scholes model, and it'll be the modification of our classical Black-Scholes model from financial options to real options. But first of all, let's determine the main factors which can influence the results of our flexibility. On the one hand, all these factors are the same as our Black-Scholes model, but then we'll transform these factors for our possibilities, for our flexibility of our company. First of all, the market value of the underlying asset on which the option is contingent. The exercise price of the option, and in our real option, the exercise price will be replaced by our capital expenditures of the project. The time remaining until the maturity of the option, and the volatility of the underlying asset, and certainly our risk-free rate of interest. Our risk-free rate of interest can be named as alternative investments for our project. We can start investment project and find our real option in this project, or we can use the alternative investments in bank, for example, and deposit of bank. And now let's transform these factors for our real options, and let's find the peculiarities, the special characteristics for our financial option, first of all, and for our real option. First of all, time to expire. A longer time to expiration will allow us to learn more about the uncertainty, and therefore it will increase option value. In this situation, the longer the period of using our license, our patents, the higher the value of this flexibility will be. And certainly, if we must realize the project, certainly we have no opportunities and changes our project. But if we have a period of time to start this project or to defer the starting of this project, certainly the higher the value of flexibility. Uncertainty, volatility about the present value. And in our case, this uncertainty will be presented in form of our standard deviation, first of all, and in an environment with mental flexibility, an increase in uncertainty will increase option value. Our investment costs can be named as the strike price of your option. In other words, for receiving these benefits, for receiving these profits, you have to pay, you have to realize capital expenditures. A high investment cost will reduce net present value without flexibility, and therefore reduce option value. In other words, certainly a higher level of our investment expenditures can lead to negative results of our investment project. And expected present value of cash flows from investments, it's a classical example, first of all, of our spot price. And in this situation, under the pressure of our spot price, it means the higher the level of our spot price, the higher the value of our flexibility. An increase in the present value of the project will increase the net present value without flexibility, and therefore the option value will also increase. Our risk-free interest rate, can be named as alternative expenditures or alternative investments for us. An increase in the risk rate will increase option value, since it will increase the time value of money, advantages in deferring the investment cost. And the last component, cash flows lost to competitions who have fully committed, or our losses in dividend yield, as we can name this category. Increasing cash flows lost to competitions will clearly decrease option value. If in this situation we receive a higher level of losses, certainly in this case we have to reject this real option and company's valuation. And if we are making the conclusion about our significance of real option are most valuable when you have exclusivity. If you have a monopoly in company's valuation and in project valuation. You and only you can take advantage of this contingency. They become less valuable as the barriers to competition become less steep. And returning for our classification, let's finish with the classification of our real option. First of all, putting real option to the test and our exclusivity. Product options, patents and drag. Patents restrict competitions from developing similar products, so patents don't restrict competitions from developing other products to treat the same disease. How do you think in this small test, in which cases the value of our real option will be on the highest level, in the first case or in the second case? In the first answer or in the second answer. Patents restrict competitions from developing similar products, so patents don't restrict competitions from developing other products to treat the same disease. How do you think? In which cases we can expect the higher level of our real option? How do you think? In the first, good, exactly, thanks a lot, Sofia. Patents restrict competition from developing similar products. Thanks a lot for your answer. Perhaps it's correct. Natural resource options and undeveloped oil reserve or gold mine. Natural resource reserves are limited. It takes time and resources to develop new reserves. How do you think in which cases the value of our real option will be higher? Natural resources reserves are limited. It takes time and resources to develop new reserves. In which cases we'll receive the highest value of our real option? Let's have open again. Natural resources reserves are limited, or it takes time and resources to develop new reserves. In which cases our patents or our license will be on a higher level of real option, or in which case could we expect the inclusivity? Just a second. How do you think? In the first case or in the second case? Natural reserves are limited, or it takes time and resources to develop new reserves. How do you think? To tell the truth, in all two cases, we can find our real options. And certainly the value in two options will be on the highest level. The second one, thanks a lot. Let's return for definition of this task. Good. It takes time and resources to develop new reserves. Exactly. In all these cases, as I started earlier, in all these two cases, we can meet real options. And in all to these cases, the value of our real option is on the highest level. But I can agree with you, if it takes time and resources to develop new reserves, and if we possess the license, certainly we can realize this project very quickly on the one hand, and we can be the first in our investment activities. Good, thanks a lot. And now let's start classical taxonomy of option or classical classification. Let's start classification of our real options. And as I said earlier, there are different kinds of our real options. And if we compare our real options with financial options. For financial options, all aspects are very clear and very determined, very direct, determined, comparing with our comparing with our real options. To tell the truth, certainly I'll propose you the classification of our options, but to tell the truth, in your experience, in your task, you can find another kinds of options. And I can't approve and I can't propose this classification as a totally finished classification, as a totally ended classification. As about our financial options, we divided our financial options into two parts: our call option and our put option, or our American style, European style of option. Certainly, our call option, our put option, our American style and our European style will be met in the context of our real options. But I can't convince our classification of real option as very strong, as very ended, as very defined. Perhaps analyzing our company's activities, we can find another kinds of our real options. First of all, as a classical kind of our option, I can propose you abandonment option. In other words, the option to abandon or sell a project, to leave a project, to abandon the project, or perhaps to, first of all, to sell all equipment, all plant, all technologies, and receive the scrap value of this project. If we are finding them similar characteristics between our abandon option and our financial option, I can name this option as a put option to realize the capacity, and as the American style of our option, as you receive the opportunity to sell the technology in determined moment of time. If the bad outcome occurs in the end of the first period, the decision maker may abandon or leave the project and realize the expected liquidation value. Then the expected liquidation or sale value of the project may be thought as an excise price of the put. In other words, you have signed contracts to abandon the technologies and the equipment and the resources of your project as your fixed assets, as your equipment, as your land, and so on. And a project that can be liquidated is worth more than the same project without the possibility of abandon. In other words, when you calculate net present value of this project, you calculate net present value based on expected financial results and plus the liquidation price or the liquidation value of the equipment or the technology. The second kind of our option to defer developing. Perhaps this option has similar characteristics with put option or perhaps with a call option. In most cases with a call option and American call option on stock. In other words, if we propose the definition of this option, the option to defer an investment to develop a property is formally equivalent to an American call option, and the owner of a lease on a developed oil reserve has the right to acquire a developed reserve by paying a lease on developing cost. You can force your project. You can decrease the force on your project. In other words, you can change the developing of your project. And for example, if we are defining the conditions which can influence the result of your project, perhaps our risks, perhaps different external conditions such as oil prices, such as government, such as different inflation rate, current exchange rate, and so on. The owner can defer the developing process until oil prices rise, for example. In other words, the managerial option explicit in holding an undeveloped reserve is a deferral option. The expected developing cost may be a third of the exercise price of the call. And the next parts of our options, now if we are checking our time, now we have the break, and after the break we'll return for classification of our option. Now, according to our schedule, we have the break, we have the rest, and the duration of this rest is 30 minutes. After 30 minutes, we'll continue our topic of real option valuation. Now, let's have a rest.